The Federal Reserve just released its 2026 bank stress test results. All 32 of the largest U.S. banks passed, even when the Fed simulated a very severe recession. A stress test is basically a simulation. The Fed creates a hypothetical worst-case economic scenario and checks whether big banks would still have enough money, called capital, to survive and continue lending to households and businesses. In this year's test, banks were projected to absorb more than $708 billion in total losses. Despite those massive losses, their overall capital only declined by 1.6 percentage points, and every single bank stayed above the required minimum. The hypothetical scenario included unemployment rising to 10%, home prices falling 30%, and commercial real estate prices dropping 39%. It was designed to be very tough. Here's one of the most important terms: Common Equity Tier 1 capital, or CET1. This is the highest quality capital a bank holds, mainly common stock and retained earnings. It acts as the main cushion to absorb losses. Even though the banks passed, these stress test results will not change how much capital large banks are required to hold. Those requirements will stay the same until 2027. For regular people, this is generally positive news. It suggests the largest banks are well positioned to keep lending, even if the economy weakens significantly. This supports overall financial stability. That said, stress tests are only simulations. They don't capture every possible risk in the real world. So, the big banks passed this year's stress test. What do you think? Does this make you feel more confident about the banking system? Drop your thoughts in the comments. If this helped explain things clearly, hit subscribe and turn on notifications. Remember, this is for information and education only, not financial advice. Always do your own research. I'll see you in the next one.